A recession is coming, and it can either destroy you or it can set you up to create wealth. The question is, are you prepared for it? Welcome to this episode of the Affluent Entrepreneur Show. And we're going to answer that question. We're going to make sure you're prepared, because here's the thing. More millionaires are typically created in recessions and depressions than any other time. So let's make sure you're one of them. I'll see you in the video. You heard me right. A recession is coming. Now, I'm not talking about creating fear and all that stuff. Here's the fact of the matter, is that recessions are parts of our economic cycles. There's going to be one coming, okay? So let's understand what it is, how it can affect you as far as your wealth, your ability to live, your income, and your lifestyle, how you can prepare for it, and how you can use it to your advantage, okay? Because here's what we know, is that recessions are just part of the cycle, and really, if you look at data, more millionaires are created during depressions and recessions than any other time. If you think about what Warren Buffett says, he says it's during the times of struggle. He says the reality is that I want to be buying when people are bloody. I want to be selling when people are greedy. And so what I want to do is really start to understand what are the dynamics. What is a recession? So let's just talk about what a recession is first, so you get clear on it. And when we think about a recession, it's an economic downturn, okay? The way they technically talk about it is that it's 2 consecutive quarters of GDP decline, gross domestic product decline. So now, I'll be honest with you, the GDP numbers, we don't know if they're real or if they're manipulated or anything, but they measure it technically based on that. So let's just look at some stats, because I think it'll help you understand some of this. Is that, like I said, 2 consecutive quarters of GDP decline. The other thing that you'll see is that the average length of a recession. Now we're looking. I went back and looked since World War II, so we went back a few years. Is 11.1 months. Okay, 11.1 months. So almost a year. And so it declines. Now the longest time is the 07-09, the 2008 recession. Now that is the longest time since World War II. We had some others prior to that, 18 months. Okay, so if we think about a recession, it's a year to a year and a half, maybe 2 years is what it looks like just from the data from before. Now, the question then is, so how often does it happen? And the frequency it's about 58.4 months, about every 5 years, just shy of 5 years as it happens. So here's what we know. The fact of the matter is, it's not if there's going to be a recession. Could it be this year? Could it be next year? I don't know. It's just, the question really isn't if. The question is when, how deep, and how long. And if anyone can tell you that absolutely, without question, a recession is coming this year, next year, the year after, run. They don't have that crystal ball. I can't tell you that. But we know that just as a part of the natural cycle of economics, recessions happen. We've been in a bull market for 11 plus years, since we got through the 2009, we've been running, and we've been doing good. We had the hiccup in 2020 for sure, so I expect a recession to come, a correction to come. I expect a downturn. And so if we plan for it and we understand it, you'll see how things work differently. Now, I think there's 2 things that we need to realize, is that there are 2 effective emotions that go on when it comes to money, when it comes to investing, and when it comes to your investments and the market. So what happens is that there's 2 driving emotions in there, and what they are is fear and greed. And the reality is that people get fearful faster than they get greedy. What does that mean? So here's the thing, and I think we can look at things and start to ask ourselves, where are we with respect to fear these days? And one of the ways that I look at it is I look at a chart called an index called the VIX. It's a measurement of the volatility in the market. Okay, it's the measurement of the volatility in the market, and when you look at it now, I look at it and I say, it also could be a measurement of the level of fear that exists in the market. And if you watch what happens, so this part, the green and red, that's the VIX. Okay, so you see that it's going up and down, it's going up and down, then it shoots up, okay, and then it goes way up. Okay, that's the VIX. Okay, the blue line, this blue line here, is the stock market. Okay, but what I want you to see is that, so this is right here, this is what happened in 2020, this is the pandemic. Okay, this was the hiccup in 2019. Okay, watch what happens. This is where fear is high. Okay. And when fear is high, what happens to the market? Goes down. Why? People are scared and they start selling. So you have what's called panic selling. Now, what ends up happening is they sell companies that are actually good companies. And if you know what happened in the hiccup in 2020, people that got out lost money, and they sold at the wrong time. They panic sold. They didn't look at the companies. They didn't analyze the companies or the charts or the investments. And the people that stayed in recovered the downturn and grew from there. And so what I think that we need to understand is a couple things. Is that when fear is high, look here, fear's high here. What did the market do? It went down. Okay. Fear is high here. Market went down. Okay. So you'll see that there's some hiccups here, that this is what just recently happened. Fear is high here, and the market, that was our little drop. Okay, so I only tell you this isn't a way to tell whether the market's going to go down or up. I mean, you can use it as an indicator, but I think that what we need to understand is the market is as much driven by logic as it is driven by emotion, and especially with retail investors, individuals that are investing through TD Ameritrade and things like that. If they're not trained, if they don't have the right training or the mentorship, or they don't have the right guidance with respect to rules and principles and that, their emotions take hold. And when their emotions take hold, and I've done shows and videos on this, they make irrational decisions. And when you make irrational decisions, you have a slide. You have a slide. Now, let me show you another thing, another chart. Now, this happens to be, if you look at the market, this is the Dow Jones, okay? What I want you to see here and just notice, and this is why I said they get fearful faster and harder than they get greedy. So if you look at the downturns, what do you notice? The downturns are much steeper than the ups. What does that mean for you? What that means is that when people get fearful and they panic, they sell. And when they sell, things start to skid, because what causes a stock price or a stock price to go down? More sellers than there are buyers. Okay? And what happens is that we have panic selling. People sell, they're scared, they want to get out before they get hurt any worse than it was. And what ends up happening is that they dump the stock. And what happens is it slides. And so when you look at this, but then it settles down, because all of a sudden people look back and go, wait a second. All right, wait a second. These companies like the S&P 500 or the Dow Jones, they're good companies. Things didn't change. There was an event that triggered the sell. There was an event that triggered the panic. Whether it's, an invasion of a country, whether it's inflation, whether it's earnings on a specific company, whether it's an increase in interest rates, whatever it is, there's this triggering event in many cases. And that triggering event causes people to panic. Now, those that stay in, let me get rid of some of this, they know what happened from there. Okay, this was again March. Okay, so they sold and they got out somewhere in here, but the market kept going up and it recovered. Now, if we were to zoom in, which I can't here, but same thing, we had panic selling here. And now it's gone back up again. Okay, but the real key I want you to understand is you see how much faster and harder things fall than they go up. And why that's important is that's where the panic starts to really set in, because now all of a sudden you're going up. It's just like a roller coaster. The hike up is slow, it's steady, it's longer. The drop is steeper and faster. And if we understand that, then we won't allow that drop to cause panic, and we'll go back to our rules, we'll go back to our principles, we'll go back to the things that we're doing and say, is this still a sound investment? Is this event going to make us want to sell it? Not emotionally, logically, analytically. Does it make sense to do that? Now, having said that, I just wanted to give you kind of a quick rundown of what it is. Now I want to give you the 9 things that you can do to prepare for an impending recession, whenever it is. Like I said, I don't know whether it's next week, next year, 10 years from now, 5 years from now, but it's coming. We might as well be ready. Okay? We might as well be ready. So let's just look at it. There's 9 things I want to take you through. Will help you prepare so you don't get hurt in a recession. You can take advantage of the recession. The first is this, is just accept it. Okay? Accept it. A recession is going to happen, and anticipate it. So plan for it. Now, here's the important thing. I don't want you living in paranoia. I want you to prepare and plan for it with the way you trade, the way your portfolio is structured, how you're living, all those things to prepare for it. So if and when it happens, one, you're not surprised. You know, there's a thing. When I had the martial arts studio, I remember parents would come in and say, I don't really want my child to spar, which, is fighting. Now, we didn't do a lot of heavy contact, and we were still gloved and padded. But I said, why is it? Well, I don't want to teach them to fight and everything. Well, you're in a martial arts studio. It is about fighting, but it's about more. But the important thing, as I said, one of the most important things that they're going to learn during the sparring is that they can take a shot and keep on going. But if we don't train them and we don't anticipate it, if they don't understand it, the shock of the shot takes them down because they've never experienced it before. So the purpose behind this video is really to prepare you for the shot. So you're not surprised. When it happens, and it will happen at some point, when it happens, you're cool. You go, I knew about this. I'm good. We're good. We've done some of the things. We've done the 9 things that Mel's going to tell us, and I'm good. So the first thing is to accept it and anticipate it. The second is this. You need liquidity to sustain you during the downturn. This goes back to to my wealth priority ladder. In the wealth priority ladder, I went into detail on this in my show, episode 24. So episode 24, if you want to go into detail about it, is that one of the elements there is to have a peace of mind fund. If you have liquidity, in other words, what I mean is you have cash that you can get access to. Because in a recession, sometimes people lose jobs. They lose projects. They lose business. And now all of a sudden, we don't have the income coming in that we once did. Okay? I remember my dad coming home after they terminated him and what that was like in our household. So he had to look for another job and everything. So, but if we have liquidity, in other words, if we have the peace of mind fund like we teach in the Affluence Blueprint in my master's program, where you have the funding, the liquidity in place, then you can sit back and say, I can weather this storm. I can weather the storm. We're good. And that's going to shift a little bit depending on your age, depending on where you're at. But we need liquidity to keep us going. And if not to keep us going, to give us that's why I call it a peace of mind fund, to give you the peace of mind and alleviate the stress of what could happen. If you're living check to check and you have a bunch of debt and you have no money in the bank and you see that the economics are starting to go against us, in other words, inflation keeps going, interest rates are going up, things are less affordable, companies are starting to lay off, those kinds of situations, it can be stressful because you have no cushion. So let's make sure that we've got a cushion. So that's number 2, is to get the liquidity in place, which then leads me to number 3, which I think is really important. That is to make sure that you eliminate debt and debt growth. In other words, we need to start doing some things to get us out of debt. The lower the amount of debt that you have. Now I'm talking primarily credit card debt, consumer debt, that kind of thing. I'm not as much talking about the mortgage, but we can talk about that in a different way. Is that the lower amount you have in debt, the less you're going to have the need for income and that liquidity. If I have no credit card payments, the only thing I'm paying is and I have no car payment, I have no student loan payments, and the only thing I've got is my mortgage or my rent and my living expenses, it's much easier to get yourself through that downturn if and when it happens. And when I say eliminate debt and debt growth, what I mean by debt growth is we don't live on our credit cards, okay? Let me make sure you hear that. We don't live on our credit cards. That's a mistake. That's a mistake. When we are financing our current lifestyle on our credit cards, this will start to create a problem. And so we need to stop that. That leads me to number 4. Number 4 is a cash resource plan. Now, some people will call it a budget. I call it a cash resource plan. In other words, I want you to know where every dollar is coming from and where every dollar is going. In other words, I want you to assign a job for every dollar. This dollar is for my financial future. This dollar is for my liquidity. This dollar is for my mortgage. When we start to tighten up and understand where the money is coming from, we know which things that we need to dial back if things start to get tight, and which things we can increase when things start to loosen up. The whole idea is to be informed, intentional, and aware, and not blindsided by what might happen. Okay? That then says what I want you to do is to follow now the wealth priority ladder. And like I said, the wealth priority ladder, I went into detail in episode 24 of my show. So I want you to go to that episode. I want you to go through it, but it'll take you through the levels. And what this talks through is what is the priority of utilization of your income and your cash to, one, give you a solid financial foundation and to build wealth from in moving forward. That then gets me to number 6. Know your risk capacity and your risk tolerance. This is about your investments, and this changes depending on where you are and what your circumstances are. But let me explain to you what that is. Risk capacity and risk tolerance. Risk tolerance is your mental state, your ability to tolerate volatility in the market, ups and downs. Some people will sit back and say, I'm okay with it. Now, they say it. The question is, are they really okay with it? Because in the heat of the moment, they may find out that I thought I was okay with it. I'm not, because I just lost 20% of what I have. And so that's risk tolerance. But then there's something else called risk capacity. That is your ability to recover from a downturn. In other words, the capacity. That means that, like, for instance, I'm 60. I don't have as long a runway to allow the market to come back. Remember, it goes up slower than it goes down. I don't have as long a runway to allow it to come back than a 30-year-old does. So I need to understand that my capacity to sustain myself may be lower. Now, because of the level of wealth, I have capacity to sustain myself much greater. And the best way to understand your risk tolerance and risk capacity is go through a risk assessment. We have one that we use with our clients in the Affluence Blueprint and everything. But you can look for a risk tolerance or risk capacity. Risk capacity is more of a calculation, whereas the tolerance is an assessment that you can go through. If you are with a financial advisor, they should have done it at the very beginning. Understanding your level of risk tolerance and capacity is part and parcel to designing the portfolio that's going to fit your needs and what you're trying to accomplish. And so I would invite you, if you haven't done it, and if you have done it, I would invite you to revisit it, is to go through an assessment of the level of risk that you, one, have the tolerance for, and two, the capacity to sustain, solely so you're informed, solely so you understand where you're at. That then leads me to number 7. And number 7 is all about diversification, because with the risk capacity and the risk tolerance in place, you now know how to structure a portfolio that fits the level of risk tolerance and risk capacity that you have and the stage and the circumstances that you have in life. Now, I want to clarify something because I think this is really important. We talk about diversification a lot in the construct of a portfolio, but you'll see that what I have here is I want you to also look at diversifying your income streams. And this is something that isn't talked about a lot, but it's something that I talk about a lot because I think it's extremely important for us to diversify the income streams that we're running. Because if I have one income stream, my salary, my business, and that gets shut off, I lose my job. I have a restaurant and the restaurant gets shut down because of a pandemic or something. I have no ability to earn. That means I have no more cash flow. I'm choking at that point. We talk about something called the 5 incomes. And one of the things that I think we all need to start considering is to have a diversification of where my income comes from. Now, your primary income might come from your salary. Your primary income might come from your business. But there are other things that you can put in place. I've got a dear friend that I've been working with, and we had this very conversation because he had his business. He was making money in his business, but if he wasn't running it, he wasn't making it. And if something happened to him, it was going to be an issue. So we went through the 5 incomes and we created a portfolio of real estate. And that portfolio of real estate is it'll produce gross probably $700,000 a year for him. Net, about $400,000 a year. So think about it this way. That's $35,000 a month without his business. So if the business has an issue or he decides he doesn't want to work or something, he's still got this income stream, and then he's got other income streams that we're putting in place. And so I want you to start to consider, how do you diversify your income streams? How do we find other income streams? It might be a side hustle. It might be, you might have some expertise in a specific thing, whether it's a foreign language, that maybe you do tutoring on the side. Just to have some income coming in from another place that helps you in a couple of different ways, because one, you have an additional income stream to support you if something happens to your primary income stream. 2, you have additional income that you can use to fund your liquidity during this time that you don't need it. So you're building the liquidity. And 3, you can use it to fund your investment portfolio. And so there's so much that can be done by making sure that you have diversified income streams, but we don't think about it in that way. Then number eight is all about keeping investing and savings mindset. Okay. Here's what I mean. When we see a downslide, when we turn around and see the market's going down, when we see a market going down like that, and we let our emotions run away, what ends up happening is we panic and we sell. And what we really need to think about is to sit back and say, wait a second, I'm an investor, and an investor is long term. So if in the day, in fact, we had a day just recently where there was a 1,200 point swing in a day. The market went 1,200 points one way or the other. Well, that shook people, and people sold, and people got out, and then people came back in. But if we look at just that little segment, 1,200 points down and then back up, it freaks people out. That is a micro kind of segment of the market. But what we're investing for is 10 years. We're investing for 20 years. We're investing for 30 years. Do you know that the statistics have shown that in any 10-year period of the market, it has gone up 96% of the time when you look at 10 years as a block? So I want you to keep in mind, one, an investing mindset, and two, a savings mindset. In other words, build liquidity. There's another benefit to having liquidity. And that is this. One, it gives you peace of mind. Two, you're in the process of building liquidity, you're going to be a little more diligent about what your spending is. Now, I'm not telling you to be a miser. I'm just telling you to be aware. I'm telling you to be intentional. I'm telling you to be conscious and not just flippantly swiping the credit card or tapping the phone and saying, I'm buying. Yeah, what the heck? Putting on payments, putting it on credit cards. But the other benefit is that you have the liquidity. Remember I said at the very beginning that more millionaires are typically made during depressions and recessions. And it's those that have the liquidity to take advantage of the opportunities that exist when things decline. So if there's a recession and prices drop on real estate or on stocks and investments, everything, and you have the liquidity, you can step in. Remember Warren Buffett said, you buy when people are bloody. The liquidity will be your savior in that process. And then the last part of this is this. Watch your mental state. This is huge. When we go into a volatile time, when we go into a challenging economy, you're going to get a barrage of information thrown at you by the media, by social media, by what you read, all of those. And they're going to incite panic, fear, doomsday, Armageddon's here, all of that. If we look at headlines that have been published throughout the last couple of years, you will have seen the same thing over and over again as far as fear and, oh my gosh, we're going down, and the Fed's going to raise interest rates and it's going to destroy, and all these things that are coming in, and they haven't come to pass. But why is that? The reason is this. We need to understand that most of the media, they're not actually in the business of selling news. They're in the business of getting eyeballs, viewers, and readers. And the best way to do it is to stir the emotions up, get people talking. And if we're not careful, if we are not standing with vigilance at the gate of our mind, our emotions will take hold. And we will live in fear, we will live in stress, we will live in a space that's not productive. And so when we have situations where we've got inflation and prices are increasing, and maybe we have a recession because of what's going on, we have a raise in interest rates, we need to be methodical. That's why I wanted to go through these 9 things. I want you to be methodical. I want you to get an understanding. I want you to get educated. And educated, follow me, listen to my show, my YouTube channel, all of that. Get books, do the things that will make a difference, that will increase your knowledge so you're not held prey or victim to all the stuff, the barrage of media stuff that might be coming in that is there for ratings and viewers and not for your best interest, in my opinion. And that was me on a soapbox, folks. But the fact of the matter is I want you to have your critical thinking factors on. And one of the ways to help you with that is to make sure that you're doing your best to educate yourself, to work with yourself, to make sure that you step up. And I get it. Sometimes this money stuff, and the media's complicit in this too, it seems complicated. It doesn't need to be complicated. The whole purpose of my show and these videos is to try and simplify it for you, because it is simple. Let's give you the tools. Let's make it happen. And so, a couple things before I close. If you haven't gone through it, I want you to go to episode 24, go through the wealth priority ladder. Understand how to use your cash in the most effective way to, one, give you a solid, unshakable financial foundation, and to make sure that you're building wealth. And number two, if you have debt, I want you to go to episode 40. Because I'm going to walk you through how I want you to look at paying down debt. It's not what some of the people out there are saying, and I give you the reasons why. I don't necessarily agree with all of the advisors and commentators out there, especially if you're an entrepreneur. So go look at episode 24 and 40. Let's get you out of debt. Let's keep you moving. Let's give you an unshakable foundation, and let's not worry about the recession that's coming. All right? I look forward to seeing you in another video, and let me know. Leave a comment below. Questions below. Let's make sure that I help you out and that we're on this journey together. Until we see each other in the next video, make sure to always strive to live a life that outlives you. Cheers.